Warren Buffett once said, "If you don't find a way to make money while you sleep, you'll work till you die." If you want to avoid that, then you need to invest. So in less than 5 minutes, I'm going to explain the basics of investing. I'm Jason Butler, and I've spent over 30 years studying the traits and skills of people who achieve financial success. Investing is the process of converting the money you earn from working, known as human capital, into assets that work to earn you money, known as financial capital. The amount of financial capital you accumulate depends on 3 key factors: how much you invest, how long you hold that investment, and the annualized investment return you achieve on that investment. The simplest way to illustrate these principles is through an example. Sarah and Anil started work at the same time at the age of 20. Sarah invested £2,500 each year until she was 30, and then she stopped saving and investing and left the money invested. Anil invested nothing until he was 30, and then he invested £2,500 each year for the next 40 years. So Sarah had invested £25,000 in total, and Anil had invested £100,000 in total. They both managed to achieve the same average annual investment return on their capital of 7% per annum. By the time they were 70, Sarah's financial capital was worth £19,000 more than Anil's, despite Anil having saved 4 times more than Sarah. So the earlier you start investing, the longer you leave it, and the higher return you achieve, the more financial capital you accumulate. Financial capital is either liquid or illiquid. Liquid means that you can easily get your hands on your money. Illiquid means it's harder or will take longer for you to get your hands on your money. Liquid financial capital includes cash deposits, fixed income bonds, and equities quoted on a stock market, otherwise known as shares. Illiquid financial capital includes all forms of physical property, like homes, factories, warehouses, and shops. And it includes ownership of private businesses and possessions like cars, boats, jewellery, and precious metals. I'm just going to focus on accumulating financial capital through liquid financial assets like cash, bonds, and shares. Cash is money held by a bank where the capital is secure, but the return in the form of interest is very low. Interest is usually less than the rise in the cost of living each year. So in this sense, cash held for very long periods of time devalues because you can buy less and less with it each year. Bonds are where you lend money to companies and governments in return for interest that is usually higher than cash. And you can sell that asset to other people at any time. Shares mean you own a small part of companies that provide products and services, like Coca-Cola, Apple, and Unilever. So you can share in the profits that they make by way of regular cash payments called dividends, and a rise in the share price due to retained profits and growth in their revenue. As you can see from this chart, over very long periods of time, the highest cumulative return has come from shares, followed by bonds, followed by cash with the lowest. But the journey for those longer, higher returns from bonds and shares was very choppy, because on a day-to-day basis, the supply and demand for bonds and shares causes their value to move up and down, sometimes by as much as 40% in 1 year. That day-to-day fluctuation in values, known as volatility, is the price that you have to pay to capture those longer-term returns. For that reason, you shouldn't invest in bonds and shares unless or until you've built an adequate emergency fund. That means a cash pot of between 3 to 6 months of essential living expenses. And you should also make sure you've got rid of any expensive non-mortgage debt like credit cards, overdrafts, and loans. Then you can start investing a regular amount each month into a combination of bonds and shares that fits your risk profile. By investing in a combination of bonds and shares, you can also reduce that day-to-day fluctuation in the value of your investment, but you can't get rid of it entirely. The simplest way to invest in bonds and shares is to invest in a global index fund. This is a low-cost way of owning a tiny bit of companies like Facebook, Tesla, Google, BT, and Legal & General, and bonds from those large companies and governments like the US and the UK. A global equity index fund and a global bond index fund are well diversified, low cost, and easy ways to invest. And if you invest in tax-favoured accounts like a pension or a lifetime individual savings account, you can also get tax benefits. And if you're employed, your employer and the government also pay into your investment pot through what's called a workplace pension. That's free money. You should aim to regularly invest 15% of your household net income into financial assets for the long term. You can build up to that if you're just starting out, as we saw with Sarah and Anil, that early investments make the most money. Beyond any workplace pension available to you, you can invest directly with big investment firms like Vanguard, Fidelity, or Legal & General. Or you can invest in one of the big investment platforms like AJ Bell, Hargreaves Lansdown, or Interactive Investor. or you can use an investment service from one of the new online digital investment providers like PensionBee, Moneybox, or Wealthify. If you want help and advice with getting started investing, check out firms like Open Money, Money Farm, or Nutmeg. And if you have more substantial money to invest and want more personalised help, take advice from a fixed fee independent financial advisor. So there you have it, the basics of investing in less than 5 minutes. When you're ready to start small, build the investing habit, get better later. Remember, you're looking for progress, not perfection. Best of luck.